Hello and welcome to our next NAP. NAP stands for Nonprofit Auditor Points, and I'm your nonprofit auditor. I designed these NAPs to help nonprofit community to address some common questions around accounting, finance, and compliance. NAPs are not authoritative, they based on my experience, laws and regulation as I understand them, being many years auditor and having my own practice where we serve nonprofit organizations by providing audit and tax filing services. Okay, today I want to talk about very simple, but in my opinion, very critical topic that often is overlooked. It's a organization of your chart of accounts. Very often working with nonprofit organizations, we identify difficulties of audit their books, not because of the complexity of the service or operations that they provide, but because the organization of chart of accounts. Sometimes nonprofits fall into some incorrect beliefs that makes their chart of accounts very difficult to manage. I view chart of accounts as your piece of machinery, or let's just say the filing system, or maybe your book. Can you imagine how easily that would be for you to find information in your favorite book if the pages were different format? One small page, another large page, they would be out of order, they will be different colors. It would be very difficult to manage. Same goes with the chart of accounts. If your chart of accounts are organized in a understandable, proper manner, your accounting records will be easily maintained, understood, and audited. So before we proceed, first of all, I want to explain what chart of accounts means. It's your name of general ledger accounts. For example, nonprofits have list of chart of accounts listed in a year like trial balance. You see the account, for example, cash, investment, building, land, note receivable, net assets. Those are separate accounts and they create your chart of accounts. Chart of accounts, it's a number and name of the account where you record transactions. And every nonprofit, like any organization, any entity, any company, business, have an opportunity to create your own chart of account. So the rule of thumb that there are some basic rules how chart of accounts needs to be created. And some basic rules are followed, but some nuances very often are missed that makes your chart of account disorganized and very hard to manage. So let's see what your nonprofit can do to structure and design efficient and effective chart of account. So first of all, chart of accounts needs to be organized in the same manner how your financial statements organized, meaning balance sheet first, then income statement. So it means that first it needs to be all assets, then liability, then net assets, then revenue and expenses. And for most nonprofits, they do follow it. One common, I would not call it mistake, but one common thing that we see often, nonprofits create below the line accounts and they can put some revenue and expenses there That's not preferable. I would say follow this standard: assets, liability, net assets or equity, revenue, and expenses. That's it. So in this way, if you structure your chart of account this way, you know your all assets here, your all liability here, net assets here, revenues here, expenses is there. So first of all, it's order. Now, in every accounting system, you will have to design name of your account, number and name, and tell the system if it's asset, liability, and so forth. We already described that you're going to have assets first: liability, net assets, revenue, and expenses. So you're going to have 5 categories. Therefore, make sure that you come up with the numbers first. So let's just say your asset will be all 1,000 accounts. All of them, 1,000. For example, I just give you an example. You can decide differently, but it's going to be 1,000. So you will start with 1,000, then the next account going to be 1,010, 1,020, 1,030, and so forth. It's all your asset accounts going to be start with 1,000. Then you go to liability. You're going to say, okay, liability accounts all going to start with 2,000. 2,000, then 2010, 2020, 2030, 2040, and so forth. Net assets or equity, you will say, okay, they're going to start with 3,000. So you're going to say 3,000, 3,010, 3,020, 3,030, and so forth. You can have as many accounts they have inside. You're going to have 1,000 placements there, right? Revenue, you're going to say, okay, I'm going to start revenue with 4,000. So every time you see 4,000 account, you know it's revenue. Then expenses, you're going to say, we're going to start with 5,000. So you see 5,000, you're going to start expense accounts. That's it. So this way, just by looking in the number, you already know it's asset, liability, net assets or equity, revenue, and expenses. Why is that critical? Because very often we see the same name that organization use for revenue and, for example, for net asset account. It's called restricted revenue or restricted funds, and it could be either revenue or net assets. If you do not have a proper number system, it's very easy to misclassify the transaction, meaning record it incorrectly in your accounting system. So therefore, numbers are very critical. And what we see very often, organizations have some accounts with numbers, some accounts without the numbers at all. Every accounting system allows you to assign a number to the account. Make it a habit to go in order and use your numbering, proper numbering, whether it's asset, liability, equity, revenue, or expenses. It's absolutely have to be maintained properly. Develop it like your internal control system. Say, this is our policy regarding chart of accounts. Now, the next step is to create a name. Try to be very clear in your names. Do not make names too long that it's very hard to see what is it. And if it's revenue account, you can actually add revenue. For example, restricted revenue. Do not call just restricted, because restricted could be also net assets, equity. So again, if we're looking at the assets, for example, for your bank accounts, you can actually have cash, operational cash, money market, CD, and you can put a number there. Investments, you can say we have Schwab, and or investments in gold. If you make sure that your description of the account short and precise and distinct, try not to use the same name for, like I mentioned, revenue and net assets, or for liability. Very distinct. Another very common confused areas that we see in chart of accounts is sub accounts. A lot of accounting systems allow you, for example, to create travel main expense account and then sub account. Sub account, for example, your travel account is, we said expenses is 5,000. So your travel account 5,020, and you will create sub accounts. For example, lodging, airfare, meals, and so forth. My personal take, do not create sub accounts. Because if you start creating sub accounts every time when you record, even in single invoice, you need to split it. Oh, because invoice might include meals and also lodging, and you need to split it in two. And it's great when you remember one time. The second time, you just log in and you see travel and you just like, oh, good, travel, and you just book it to the full group. You don't splitting. What I find that very few organizations can maintain sub accounts well, and if they only can be maintained well when they're very distinct and not too many of them. If you see in travel 5 sub accounts, you can know that mistakes will happen, and then what happens, the organization gonna, oh, that's miscoded, let's move this to here, this here, and it becomes messy. Therefore, if for whatever reason your organization wants to segregate travel meals and travel airfare, create 2 distinct accounts, not sub accounts, travel meals and travel airfare. You can do that. Ideally, it's all travel. Chart of accounts should not be too big. More accounts you have, more mistakes gonna happen, more messier your book's gonna look good. You have to remember that each account has details. If for internal purposes you need some information to be more detailed, you can also drill, get your general ledger detail, extract them, and sort them in any way your management or board wants to see the information. But in the chart of accounts, I would say have probably not more than 20 expense accounts, have probably not more than 15 revenue accounts, and same goes to balance sheet. Again, if you do have smaller chart of accounts, you're gonna have a clear data that's gonna be easier to maintain. Every time we as auditors receive financial statements that based on the chart of accounts, and we see 60 expense accounts, some of them like $60, and some of them have negative balances, it tells us right away there is misunderstanding how to maintain chart of account. It's not very effective, and the organization does a lot of mistakes, and it becomes difficult to audit. Do not create accounts just on a whim. Sometimes what we see happens, there is new type of expense was incurred, and bookkeeper or whoever responsible for recording that transaction just goes to the accounting system and they not sure where to record it, and they just create a new account. And if it happens 10 times in a month, you already have 10 new accounts. And if it happens every month, in a year, you can have 100 accounts. And then it becomes so difficult to maintain. People who record unusual transactions, they don't even spend time to look if a similar account already exists, because it's so difficult to see. So they just in the process of creating accounts. The result, very hard to read, understand, maintain, and the books becomes messy. And it leads to the fact that most likely organization becomes unhappy with accounting because they do make a lot of mistake. They trying to find a new accountants, and when they come and see how messy chart of accounts is organized, they think the books are messy and they run away. So it becomes prohibitive for nonprofit to find a good bookkeeper because of the messiness of charter accounts. So therefore, what I would advise first and foremost for nonprofit to sit down and assign number group for each group. Assets, like I said, for example, 1,000. Liability, 2,000. Net assets, 3,000. Revenue, 4,000. Expenses, 5,000. Have a policy that each account is supposed to have a number and name. Number two, number three, names needs to be distinct, short, and distinct. So whoever gonna look at it, they will understand what it is, but they need to be short. Do not create names like this. Very hard. Number five, develop your chart of account, implement it, and if new account will need to be created, have a procedure. For example, your accountant will say, we will need to create this account. Make sure that's approved and it's appropriate, and you will incorporate in your chart of account. Do not just create new accounts on a whim. Number seven, try avoid sub-accounts. I would recommend do not create sub-accounts. And number eight, I would say stay away from the names that are miscellaneous, other, various, discrepancies, unreconciled. You can have one account that you're not sure where to record stuff, which should not be material number, but all these other names, they are not specific, very vague, should not have material balances, and it's not the proper name for the account. To summarize, try to develop chart of account that you and anybody who do not have accounting degree understand what that account is: asset, liability, net assets, revenue, expense, that has a very precise name and it's easily to maintain. If the accounts have a zero balance or no longer in use, make sure that you make them inactive so their transactions do not get recorded there by accident. And that would be it. I want to say that having a good chart of account, it's a very important, simple step, making sure that your books are accurate and easy to manage. Thank you so much for being here with me, and looking forward to see you for our next nap. Thank you and have a wonderful day. Talk to you soon.